James, thank you very much for joining.
Thanks for having me.
Yeah, we have 20 minutes here to learn as much as we can in that short time about Google Cloud Web3 digital business from you. Maybe just by way of context, start with a little introduction on your background and then how Google is now approaching the space.
Yeah, sounds good. So hopefully you can all hear me just fine on the headphones. So yeah, my name's Dr. James Tromans. I've been at Google about 6 years. Before that, I worked at Citi for about 6 years. And then prior to that, I did a number of startups. And my own academic background is in AI, which is the topic du jour at the moment. So I worked in AI for a long time, from fundamental research during my PhD to about 2019. And I always joke that when I stopped working on AI, that's when ChatGPT and the GPT models really took off. So I'll let you know when I'll get out of crypto, because it'll go to the moon. So yeah, so we started the Web3 business in Google Cloud about, 2021, late 2021. And in that work, we focused traditionally on the digital native space, indexing data, running nodes, helping people run validators. More recently, we run faucets for people to do engineering work to get access to testnet tokens. But over the last year, we've sort of slowly transitioned the business to focusing on the intersection of Web3 technologies and institutional finance and capital markets. And so the two topics that we'll probably talk about today are the universal ledger, which Tim kindly mentioned earlier, which you're right, I think it did, he's right, it did go under the radar a little bit in terms of the significance of that work. I think a lot of people didn't expect Google to build a layer 1 blockchain. So I'm happy to share a little bit more about that. And then similarly, the work we've been doing around agent payment protocol, I think that's a really interesting and technology business agnostic way to facilitate agentic payments and agentic commerce. So we'll talk about those two today.
Yeah, let's start with agentic commerce a bit. I get a lot of pitches these days on AI agents at Blockworks. But it means a little bit different, has a different meaning to different people depending on the context. So let's just start by defining, what is agentic commerce in the lens of payment, the payment landscape. We're not just talking about AI agents assisting users, but maybe even transacting themselves.
Yeah, so I think firstly, the work we've been doing in this space has been to empower in a safe and secure way agents to transact on behalf of consumers and potentially businesses as well, such that the intent is clear and the agent doesn't necessarily hallucinate a false capability or intent on behalf of the buyer and indeed the merchant. The work we've done in this space, Agent Payment Protocol, is an extension to our A2A work. So there's obviously lots of people are familiar with Model Context Protocol. A2A is a complementary piece of technology that I think, when combined with Agent Payment Protocol and blockchain rails, are a really great fit to support the future of commerce. But it also supports credit card payments, the heritage payment capabilities that the industry has today. But I think if we're going to get into the world of micropayments, we're going to get into the world of maybe billions of agents transacting, we need a set of payment rails that can support that. And in my view, if you want to pay for something that's maybe even sub-cent, certainly sub-dollar or pound, you need a set of technologies that can do that cheaply and efficiently. And so Agent Payment Protocol is basically agnostic to that. We did some work with Coinbase on the X402 standard as well to link the two. And the idea is that when you want to have agents paying on behalf of a consumer with a merchant, you can follow these open source standards. Our partners can contribute to them, and it can unlock potentially new business models and certainly take us forward into the future of what agents might want to do for us.
Are you seeing this first as primarily a B2B advantage or consumer-focused, or maybe both at the same time?
I think the obvious first-order implication of this technology, as it sort of presents to us as individuals, is probably on the consumer side. But I actually don't think that's where we're going to see it end. And I think actually some of the most interesting value unlock we'll observe will be in the B2B space. But of course, it's very obvious to us sat here today, even if you're not deep into AI or of course crypto, that you might want to pay for your Nike shoes. I saw a great demo from the Algorand team recently where you would be able to instruct your agent to go and do that for you. And that's something that you would probably do anyway. And it could be a holiday and it could be something else. And you can understand how you want to provide some guardrails for your agent there through digital payment credentials and verifiable credentials to make sure that you're signing for something that you actually intend to. And that's a consumer concern. But what we haven't spoken about and what people maybe would consider the second order implications are, well, when businesses can pay for in the moment, so not net 60, in an invoice, but, very much in the moment in an untrusted way. So these folks don't have to trust one another, but they can use blockchain capabilities to transact for something that is micropayment. You can imagine entire economies that don't exist today forming when you give the technology capability for these agents to orchestrate commerce between one another. And so you can imagine a whole bunch of agents paying each other for information through microtransactions on a blockchain that just couldn't be possible today. And so if it's too expensive to do today and we didn't have agents, what's possible when payments are super cheap and you do have agents? What are the new business models that will come from that? And I think that's a little bit different to just paying for some shoes, right? I think that can be an entire section of autonomous agents paying one another for things that don't even exist today. And it's difficult for us to think through all to get to the second order implications, certainly the third order knock-on effects of that. But that's what we're building towards. We want to make sure that the technology is there to enable that and to enable our customers and partners to build for that.
Okay, this all sounds very sci-fi here, but maybe just back up a little bit. If I want to look at a typical user story, let's go from the simple case first. Where is, in practice, a user benefiting, in the buying shoes example, and then I want to delve a little bit deeper into the future economies that might evolve here as well. But
well, I mean, I'm definitely not in the business of predicting the future, but in terms of just how a consumer may use the agent-to-agent and AP2 protocol, and they probably wouldn't know they're using it, right? Like the idea would be people build user experiences on top of this technology. Of course, they can run it on Google Cloud or wherever they like. But the idea would be, you might have an agent, you might instruct that agent to say, hey, I really would like these shoes, but they're out of my price range right now. Could you perhaps watch those for me and alert me to when there's a price drop? And we obviously assume that when a merchant or a vendor reduces the price, they're doing it because they want to shift stock or they want to sell more, sort of simple supply and demand economics. So in which case your agent can track that for you. It's already been given permission to buy that for you. So you actually might not even have the human in the loop. The agent can then go and make that purchase. It's all pre-authorized and they can go ahead and it's exactly what you might expect. So I think that's a nice sort of simple, easy to understand use case that would resonate with anybody here. Well,
for the traders in the audience, you're basically setting a limit order on your Air Jordans.
Yeah, that's exactly right. And I think when we think about payments, of course, payments for shoes, you could do payments for Forex, you could do delivery versus payment. The technology could be scaled to other use cases in the institutional domain. I don't see why it couldn't go beyond just businesses buying things from businesses. You could absolutely take it through to agents transacting on markets if someone wanted to do that.
Okay, so then in terms of micropayments, I mean, the one that I typically think of is maybe compensating content creators. This is something that obviously could be applicable on YouTube. What is this technology that is very close to being a practicable unlock that we don't have today?
Yeah, so I think we're sort of maybe transitioning, the conversation's naturally transitioning away from just the agent-to-agent piece. I think the opportunity of blockchain, stablecoins is the topic du jour. I think stablecoins are a great technology, but I actually think that they're perhaps being conflated with solving problems that we have already solved with commercial bank money. We can talk about that in a moment. But I think the idea that we can have cheaper rails to facilitate these types of things is only possible with blockchain. Blockchain is the technology that makes these capabilities affordable so that an agent could do this on your behalf. And so I'm very excited about how payments, which I do think remains the killer app for blockchain and Web3. I remember maybe 2014, I bought something online using my Bitcoin wallet, and the QR code flashed up. I took it with my camera, the wallet auto-populated, click pay, and 250 milliseconds later, the URL had refreshed, and I could see payment confirmed. This for me was my aha moment. And I think as the costs of using blockchain has come down, it's opening up the case for users to transact in a cheaper way. And of course, that extends to agents as well.
Okay, so you've already mentioned the Google Cloud Universal Ledger. GCUL, does that have like a fun pronunciation acronym, like G-Cool
it depends on which country. So we just call it the Universal Ledger. Okay. So yeah, I mean, the Universal Ledger it was first announced by Terry Duffy, who's the CEO of Chicago Mercantile Exchange, earlier on in the year. There was some posts that we did informally from Google Cloud on LinkedIn that kind of caught the eye of the media and users. It's a layer one proof of stake blockchain. It's built to be capable of being public and permissionless and decentralized, although that's not how it will be deployed in the first instance. So that's a policy and choice. It's not a technical choice. But the key two things that I would mention about it for this audience is, firstly, I've long been sort of wondering, is blockchain this technology in search of a business problem? And for us, that was sort of turned the other way around when I started to see the business problem, where actually agents who need high TPS and also potentially cross-border payments, which I'll mention momentarily, that you need high-performing blockchain with relatively low latency. And so the insight from our perspective was, if Google needed to build a blockchain for itself at our scale, what would that look like? What are the technology breakthroughs that we need? And then what are the business problems that we'd be solving with that? And largely, what are the business problems we're solving for our customers? So this is very much customer and partner-led. The Google Cloud Universal Ledger is sort of a million transaction per second level blockchain. In terms of time to finality, if you want to call it that, it's not quite as fast as some of the other modern blockchains, but it's pretty quick. It's sub 2 second, probably under 1 second by the time we've finished optimizing. But we're actually not prioritizing that for our use cases. But we think agents will need that level of throughput. Now, in terms of why we've opted for a private and permissioned ledger, I think it's because when we speak to our financial partners that use Google Cloud, and like I said, they're the ones kind of driving these business problems and partnership with us, they are still interested in transacting in a safe and known environment. And with the state of smart contracting today, of course, you have bridging technology, you have other capabilities. If you want to provide, say, public digital asset like Bitcoin from its native chain, you can clearly hold that in escrow on the native chain. You can use a bridging technology, and you can then provide interoperability onto a private and permission ledger like GCUL, so that trusted parties, which in this case will be the banks, governed by another institution that will not be Google, can join the ledger, they can transact with one another, and they can pay for and buy assets like Bitcoin in a safe and secure environment. And I think that the last thing I'll say is that we wanted to put commercial bank money on chain natively. So not even like a tokenized deposit, although you can think of it like that. So there's no ERC20 for commercial bank money. It's just money, and the protocol supports it as a first-party consideration. So you can think of it like a thin ledger that a bank would. Banks already have hundreds or thousands of ledgers, depending on their corresponding banking relationships. So this would be a technology that's fully managed, or if they want to, they could run a validator in the future that enables them to then increment and decrement accounts, commercial bank money, as they're regulated to do so today. So it's a multi-currency, multi-asset ledger that would enable you to do PVP or DVP in 2-second finality. We're talking to certain institutions for clearing and settlement. And yeah, if you can get digitally native assets on this ledger, I always think about it on-ramp the digital assets into the fiat world rather than on-ramp fiat to digital assets, then you can create a nice environment for these organizations to transact with one another safely, even for digital assets.
Okay, well, yeah, I mean, this is starts to get into almost a philosophical debate within crypto, is the permissioned versus permissionless blockchains. What is the role of credible neutrality? I know there is some aspect of this that you're looking towards the future of decentralizing in some way, and having a kind of neutral platform is a goal. But what is that? What is it? Can you explain how Google kind of thinks about those issues that make crypto natives, let's say, somewhat skeptical of permissioned corporate chains?
Yeah, we're not building to compete with, say, a crypto native public blockchain. I think the work that those organizations are doing and those communities are building is, firstly, very admirable, and secondly, it's quite, I mean, by design, it's to build outside of the existing financial system, right? Like, they're trying to build a set of capabilities that will mean you don't have to work with a bank should you not wish. So I think, that's why we want to be interoperable with, but not compete directly with those. The reason we've built it as a blockchain is very simple. If you're building financial market infrastructure, any regulator in the world will say you can't just run that on one cloud. You have to be able to show as a bank or a regulated institution that you can run that technology either on-prem or on another hyperscale cloud provider quickly and easily. And there's many ways you can solve that technically. Blockchain is just a very, very good fit. You can deploy another validator outside of Google Cloud. It will run. It will just work. And you have the security model that blockchain affords through consensus to be Byzantine fault tolerant. And so for me, it's a way to make a core payment rail portable to anywhere it needs to be. And I think blockchain is a great fit for that. In terms of being credibly neutral, I think the context of that statement was in the fact that you don't necessarily want to be a stablecoin issuer and own the ledger and own the apps and own the whole ecosystem. We don't want to disintermediate banks from their end customers or their end corporate users. We want to empower them with just managed technology that they can use to build better solutions for their customers. And so that's what we mean about being incredibly neutral. We're known for building great technology. We open source a lot of our work. We can run this in data centers all over the world and all corners of the world, including adhering to data residency guarantees. And so when you can offer that type of technical service to a financial organization and say, oh, we can get you Bitcoin, we can get you another digitally native asset on this payment rail as well, I think it's quite an interesting value proposition. And it's different to being a stablecoin issuer and running the infrastructure and owning the protocol.
Yeah, and we have examples of stablecoin issuers specifically launching chains, payment rails specifically launching chains. So it's going to be an interesting competitive landscape where people are optimizing for and for which customers. I want to go back to the stable coins versus other kinds of value transfer, such as tokenized bank deposits, for example. This morning there was a presentation on stable coins from Citi, report on stable coins in 2030, let's say. And one item that was of interest was suspecting that there might actually be a larger market for non-stablecoin tokenized assets like deposits that serve the same function as stablecoins, practically speaking. You alluded to this earlier. I'm curious for your thoughts on that.
It's a great question. I mean, obviously, if you're in the stablecoin business, it's natural that you'll see stablecoins as a solution to a lot of different problems. And I think in the public blockchain space, we don't really have an alternative. If you need a stable, fiat-pegged asset, I mean, by definition, a stablecoin does that. But I would encourage everyone who's working in this space to sort of step back and think about, what do we like about stablecoins? Is it we love e-money regulation? We love not getting interest on our deposits. We love them not being fungible between issuers. Do we like those characteristics? Or do we like the fact that they're 24/7, they're programmable, they can settle in 2 seconds, or they can reach finality in 2 seconds? I think we love the characteristics afforded by blockchain. I think the e-money regulation of a stablecoin, as it is in the various countries that regulate it today, that has a place, but it might not be the same problems. It might not solve the same problems as commercial bank money already solves today. So commercial bank money is regulated globally, largely in the same way. It's very well understood. The banking system's operated with it for many, many decades. And so I think Citi also have an axe to grind here. I think it's natural that a bank who will make money on bank deposits where they can loan out, I don't know the exact ratio, but 15 plus times the amount of what they're storing in reserves and make presumably greater than a base rate of interest on that. It's in any bank that can make those, that can take deposits and loan to retain deposits, right? And it's good, it's largely, I think, good for the economy. I think if everything moves to stable coins, banks can't loan against that in the same way. The regulation precludes that. And so it has quite an interesting knock-on effect. If you put commercial bank money, stable coins, tokenized money market funds, and tokenized treasury all on a ledger where it's very, very cheap to transact between them, what happens? Does money stay in a bank deposit earning relatively low interest? Does it move to the higher yielding asset? And then the assets that are, say, tokenized money market funds or treasuries, what are their regulatory characteristics relative to stablecoins? And what does that mean for the movement of value? And I think banks who are thinking about this deeply know the answer of where that's going. But as a technology provider, we just want to make sure that we're offering the right capabilities for the markets to build what they need on top of that.
Yeah, I mean, one of the things I enjoy about crypto right now, even today, it's possible to have a stable coin that's earning a yield and can be immediately usable in payments, still today through Visa or MasterCard typically, but who knows how long that will be. I think, from a crypto native lens, one of the appeals of public permissionless systems is freedom and not having to fear a vendor lock-in, however that may manifest through coercion or through just convenience. How does a giant hyperscaler like Google sort of mesh those two elements as it designs its systems for the future to be a global platform?
Yeah, I mean, look, Google obviously operates within the laws and regulations of all the countries where it does business, right? And we will always do that. So from our point of view as a technology provider, we are not in the business of speculating on what's going to be successful in terms of public blockchains or private blockchains. But we have customers asking us to build these capabilities for them, and there's a market there for that. And so it's our privilege to be able to work with these organizations like the CME, but many others, to take that forward. And I don't think that detracts from the work that's happening in the public blockchain space, which is largely solving for a different problem. And yes, they may meet, and yes, we should hope to see interoperability, but they're not, they're kind of operating in like slightly shifted spaces in my mind.
Fantastic. Well, we're going to have to leave it there, but I hope that leaves you wanting more, and you can read about it on the pages of Blockworks in the future for years to come.
Thanks for having me. Cheers.